class we will focus on the NPV calculation, which is the last step in the moment in which we want to evaluate an investment. In the moment in which we need to understand if we want to accept or not a certain investment decision, the last phase is represented by the calculation, the definition of the financial impact of our decision. And the net present value is the formula that allows us to quantify the financial impact of our decision itself. The general formula, so the NPV formula that we can apply, is the following. It should be already known, so we have that the NPV of our investment calculated at the instant zero equals the sum from 0 until capital T of the net cash flow of every year, discounted of course, so 1 plus k at the power of t, plus the terminal value, if any, at the moment of time, capital T, discounted as well. So 1 plus k at the power of the capital T. Starting from this general formula, we need to understand more in detail how we can calculate this net cash flow. Let's start from the simplest case. And in the simplest case, we do not have taxes and we do not consider the external financing. In this case, we need to understand how we can calculate our net cash flow. So the net cash flow in this simplest case, with no taxes and with no external financing, can be calculated in this way. We can say that the net cash flow equals the cash flow defined as gross operating minus the investment. We will try to understand more in detail the meaning of this formula. Let's start from the cash flow gross operating. The cash flow gross operating can be defined as the operating cash that the investment is able to generate in the future. Pay attention that with respect to the general formula, I'm not writing down every time the discounting nor the moment t, but keep in mind that in the moment in which you need to evaluate the net cash flow, you need to calculate the net cash flow every year and you need to discount the value. So I'm just considering the main element, but keep in mind that you need to discount these values. So what we need to identify every year in which we are going to evaluate our investment is the cash flow gross operating, which means that we try to understand the operating cash that is generated by our investment. We can define our operating cash in two different ways. The first way that we can use to define our cash flow gross operating is to consider the difference between the revenues minus what are defined as cash costs. So basically we are talking about expenses that give rise to a cash outflows. For example, depreciation and amortization are costs, but they do not give rise to a cash outflows. That's the reason why they won't be included in this formula. That's the first approach. We can also calculate the cash flow gross operating in a second way, which is earning before interest and taxes plus depreciation and amortization. That's exactly the opposite of the first approach. Which is the best one? Well, I would say that it depends on the data that we have. If we have information on the revenues and the cash expenses, we would use the first approach. If instead we can use the income statement, it is more probably that we will have the detail on the earning before interest and taxes, and so we would go for the second approach. Keep in mind that if you have this formula, you need to add depreciation and amortization because this value is including them, so we need to add it again in order to have the cash value. In both of the cases, either we are using the revenues minus the cash costs, or if you are using the EBIT plus the depreciation and amortization, the final result will be what is defined as earning before interest, taxes, depreciation and amortization. So if we say cash flow gross operating, or if we say earning before interest, taxes, depreciation and amortization, we are talking about the same thing. And we can calculate these either in this way or in the second way. That's the fourth component of our net cash flow. Once we have defined the operating cash every year that our investment is able to generate, we need to deduct from this value the investment. How can we calculate the investment? The investment can be calculated in this way. It is the investment into fixed assets minus the variation of what is defined as operating working capital. Let's try to understand what do I mean. We need, first of all, to deduct the amount of the cash outflows because of the investment. So if we are purchasing an equipment, if we are purchasing a software, so basically the cash outflows because of our project should be taken into account, and of course it should be deducted in order to define the net cash flow. It is very probable that the amount of the investment in fixed asset will be concentrated in the initial years of our analysis, because we are going to have the cash outflows at the beginning and then we will have the cash inflows. And then we need to deduct the variation of the operating working capital. And this operating working capital includes the variation in the receivables, the variation in the inventories, and the variation in the payables. Why should we account for these three components? The reason why is because of the cash flow gross operating. Basically, we are considering revenues, but if you remember the distinction between an accrual logic and a cash logic, the revenue is defined by using an accrual logic, while we need a cash data because we want to understand the cash in because of our investment. So basically, we need to adjust the revenue by taking into account the receivables, and we need to adjust the value on the costs by taking into account the variation into the payables. And the same happens with the inventory. So basically, in order to pass from an accrual logic to a cash logic, we need to keep in mind the variation in the operating working capital. I'm talking about variation because we can calculate this change in the operating working capital as a difference between the final value minus the initial value. Final value at the end of the year minus the initial value at the beginning of the year. Once we have this data, what should we do? Basically, we can always calculate per each of them the difference between the final minus the initial. Now, let's assume that this difference is higher than 0. Let's see the impact on the cash, which is the sign that we should consider here, if it is a plus or a minus. Assuming that we have that the receivables at the end of the year are higher with respect to the receivables that we have at the beginning. So if this value is higher than 0, what would be the impact on the cash? Just think. We have that the receivables that we have are higher with respect to what we had at the beginning of the year. This means that we have receivables rather than having the cash inflows, which means that the impact on the cash will be negative. So the cash will be lower in the moment in which final receivables are higher with respect to the initial. So the impact on the cash is negative. We need to account for a minus. We need to do the same for the inventories. If the inventory at the end of the year are higher with respect to the inventories that we have at the beginning of the year, which means that the delta is positive, the impact on our cash flow will be negative. Why? Because we have inventories rather than having the cash inflows because of the selling of the product. So basically, the impact on our cash will be negative. Inventories rather than cash inflows because of the selling. It is, of course, the opposite if we think of payables. In the moment in which the payables at the end of the year are higher with respect to the payables that we have at the beginning of the year, we have a payable rather than having a cash outflows because we are paying our suppliers. So in this case, the impact on the cash flow will be positive because we are more cash because we haven't paid our suppliers yet. So the impact will be positive. So assuming to calculate these differences always as final minus initial, the sign that we need to keep in mind in order to calculate the formula will be minus, minus, and plus. If we account for these details, then we can calculate the net cash flow every year. So every year we need to define the EBITDA, the amount of the investment, and then the variation of the operating working capital. Of course, this is the base case, so the moment in which we do not have taxes, no, we are considering the external financing. We need also to add something else, because in the moment in which we are evaluating investment, whatever kind of investment we are evaluating, we need always to use what is defined as, actually, we need to adopt an incremental logic. I'll try to explain it more in detail. So once we are evaluating investments, the calculation of net cash flow, and so all of the details of the formula should always be calculated in additional terms. Let's do an example. Assuming that we are analyzing the purchases of an equipment of a company and we want to understand if for the company it's convenient to purchase this equipment, we are considering the 2015 as a reference year, and we want to understand what happens to our cash flow in the moment in which we are doing the investment, so with the investment and without investing. We are doing our estimation, so we have, just for simplicity, the value of the revenue. If the company is doing the investment, the amount of the revenue would be 200. If the company is not doing the investment, the amount of the revenue would be 190. So basically, if we need to identify the amount of our revenue, the amount of our revenue won't be 200 or 190, but it would be the delta, so the variation between what happens if we are investing and what happens if we are not investing. This is important because this means that every data, so every revenue, cost, and all of the other details should be calculated in incremental terms. Which should be the alternative that we need to take into account as a reference term? In the moment in which the investment is a mandatory investment, one of the two alternatives represent our reference schema, while in the second case, in the moment in which the investment is a non-mandatory investment, the decision to not invest represents what is defined as the base case, so the reference line against which we are going to calculate all of our details. Finally, not only we need to use an incremental logic, but also in the moment in which we are evaluating the investment, we need to avoid what is defined as sunk costs. These sunk costs represent the expenses that the company has already paid for, and so even though they are related to the investment, they cannot be recovered anymore, so they do not enter in our analysis. Again, let's see this with an example. Assuming that we are evaluating the investment, so we are in 2014 and we are evaluating our investment that is going to have an impact on the next 5 years. Let's assume that this time horizon is 5 years. Assuming that in 2013 the company did a feasibility study in order to understand whether it was convenient to implement the investment or not. This feasibility study, even though it is specifically related to the project, should not be taken into account into our analysis because we are talking about something that has already passed. So all of the expenses that are related to our investment but that happened before with respect to the moment in which we are doing the evaluation cannot be considered, and given that we are not considered them, they are defined as sunk costs. And so we can say, if we want to conclude, that if we want to apply and if we want to calculate the NPV, we should always use an incremental logic and we need not to take into account the sunk costs.